All right, Jared, man, thanks for joining us. I appreciate it.
Yeah, man. I've been kind of waiting to chat.
Yeah. And so, Jared, I'm pretty sure I met you for the first time at one of Hydra's events. Josh Johnson was hosting an event at Hydra in Nashville, and you really came across as like the guy to know. And now, since then, I've learned that you work with some of our clients and you're very known in the space. But I met you there and wanted to bring you on to chat. So, like I mentioned before, this series, this go to market series, we're really wanting to help those brands. We primarily work in the CPG wellness space, but those brands that are just startup. So maybe they just have an idea, they haven't done anything yet, all the way into that first year. Like, what do they need to know? And especially with your expertise of finance, what do they need to know on the finance side? So if you don't mind, first, Jared, just share a little bit with the audience, just like what you do, what your background is, and then we'll go from there.
Yeah, yeah. So my it's funny this question. I never know how far to go back, right? But I've always kind of been
Right.
in finance, and so I've worked like with J.P. Morgan Chase Bank. And I know I kind of worked with Satan himself, but I did realize like corporate wasn't for me, and so where my personality aligns is really helping entrepreneurs like get to the vision that they have in their business. So like me aligning with them is like really what drives me. But I've been in D2C, e-com, when people say e-com, it's a wide range. So not necessarily like
Right.
on Amazon, but like direct to consumer for over 10 years. And the first brand that I was a CFO at, we scaled from about 4 million to 43 million in 4 years. And so really that was like my entry point into the love of not the financial aspect, but the data analytics that then predicts the financial performance, or how do you basically analyze both of those? And because we have so much data at our fingertips, so it's
Yeah.
like,
Right.
what do we analyze? How do we analyze it? Yeah. So
Yeah.
so that's what kind of got me into e-commerce. I currently live in Nashville. I moved here to be the CFO at Michael Hyatt Company. After 2 years of there, I just realized I wanted to get back into D2C, and so I resigned and started my own firm, and that's been about 3.5 years ago.
Awesome. Very cool.
Yeah,
And
yeah.
I'll ask you again maybe at the end, but just if you don't mind, like I know that you really work with a lot of clients that will be listening here. Like, what's kind of what type of client do you typically work with, or type of brand is kind of a sweet spot for you that you're able to help?
Yeah, so the sweet spot is utilizing Shopify, so selling on Shopify, and typically there's a tech stack that comes with that, right? That we're all aware of. So, but that's first and foremost. And typically who we can serve best is doing top line revenue 3 to 15 million. Now there's brands outside of that. So we have one client that's going to do 50 million this year, and we are coming out with a different product to help those kind of those those startups that are kind of
Mhm.
below or not haven't reached that 3 million mark that we're kind of really excited about right now, just because there's so many in that pool that I have seen just train wrecks of financials. So when I get to dig in,
Yeah.
and they have no base to make strategic decisions from the financial perspective. So we're creating a product there for that group of companies, but right now it's like 3 to 15 million is kind of the ideal clients that we're working with. Yeah.
Okay. Perfect. Cool. All right. So I'm going to just jump into some questions. So the questions that I have are just from context, for me for questions. So one at Lucid. So we work with at any given time, 70 or so brands where we're primarily helping them with paid acquisition, helping them scale their brands. And as you know, Jared, I think I've shared with you before, like it's amazing some of the brands that we work with where I can think of a handful right now where just like even fall of last year, I was looking through some numbers where we got one brand that they were doing like I don't know, 60,000 or so in revenue a month in like November. We're just closing up August revenue and they're doing more than $1 million a month in revenue. This is happening like a handful of times,
Yeah.
similar
Yeah.
things. And so we get to work with a lot of brands like that. So we work
Yeah.
with right now, around 70 or so brands and actively with paid acquisition, email marketing, et cetera. We also have partners in a handful of brands that have decided, hey, they want to partner with Lucid or some of the partners here where we have a piece of their brand and have some stake in the game for the future. And then we know we've launched some of our own brands, like we were talking about Breeze earlier, founded and run by the founder of Lucid, Aaron Nodbush, and just absolutely killing it over there. So a lot of the questions that I'll have are like legitimate questions. So questions that I know that have come up from a client that we work with, which by the way, we call our clients investors. So if I say investor, that's why. Actually, the reason for that is we have what, 55 or so people working on our team. And the reason we call investors is no matter who they are, whether it's a designer, media buyer, growth strategist, whoever, we want them in the back of their mind thinking, hey, this client, they're working with us because they need a return. They're not working with us because they have a bag of cash that they need to get rid of. They are working with us because they need a return. So even if I'm designing an ad or writing copy for an email, I need to be thinking mentally that, hey, this is an investor. They need to make money off of this ad. They need to make money off of this email. So just
Yeah.
reinforcing that every day is why we call them investors. So that makes
Yeah.
it so bad if I call them investors.
Got it. So I have a quick, I know like I'm on your podcast, but I always love
Yeah.
learning too, right?
Yeah, sure.
So those brands that are scaling that rapidly, is it offer? Is it creative? Is it launching new products? Like, is it a combination of all the, like, what are you seeing
Yeah.
on your side that's kind of
Yeah.
working, in
Yeah. Yeah.
those particular brands?
Yeah. And the fun thing too is actually the brand that I was first thinking about that we were looking at some spreadsheets yesterday on. That was like for the first few months, it was like, hey, just not getting traction, trying this, and just not getting traction. And what really we hit is one is the right product. So when it comes to customer acquisition, especially with D2C, like I call it merchandising, but the product matters so much. And it's not even a lot of times a brand wants to say, hey, what's our best selling product? Okay, lead with that. But your best selling product might not be the product that you can acquire a customer on Facebook or Instagram or TikTok. It might be like your fifth best selling product, but it's the right price point, it's the right pizzazz, it's the right entry point for a customer, especially on paid social. So there it was first, we kind of identified, they had all these different products. And we identified, oh, wait, this product's kind of just sitting there. This looks actually pretty interesting that we could actually run with this product to get a lot of attention. So the right product, definitely the right price point and offer. And then it's just really the right creative is how we're positioning this creative, how we're positioning, the unique selling points of this product and how somebody can envision themselves using this product. And so for us, it's really the right product and the right creative. When in creative, just a fancy word for the actual ad that they see. And so those two are the key things that we see that make a big difference between somebody that's just kind of not getting traction versus
Yeah.
those scalers.
Yeah. Well, that's great. I mean, especially because, takes a lot of testing to get there, right?
Yeah,
So,
yeah, exactly.
yeah.
Exactly.
Yeah.
All right, so let's take it back. So we talked about like the brand is just, and we have a handful of those that are doing this. Let's say we go back before they even could sell some products. So something I want to know is I know that let's say that I'm starting a brand and I'm investing the capital to get it formulated, to get it manufactured, to have the branding, to have the website and all of this. And I have a good picture of every dollar that I need to spend to get to the point to where, like you said, on Shopify, I can accept an order. So that startup capital. But from your vantage point, do you have any thoughts on, because what it isn't is, all right, I spend this much money, however much it is, and then they want to start selling, then it's just a variable cost. Like I've got money that I still need to really consider that I'm still in startup mode and some capital that I need to have set aside
Yeah.
before I start counting on sales coming in to cover my costs. So do you have any
Yeah.
thoughts on capital that a brand needs to consider to have available even past day one to start selling?
Yeah. But if we go like even a step before that is I'm a huge fan of flexibility and agility, right? Because things
Mm-hmm.
move so quick in the D2C
Sure.
space. And so even before that, when you're talking about formulations and branding and website, have you actually validated that product first or as much as you can, or can you create like an MVP, maybe take
Mm-hmm.
pre-sales, right? But because I have seen companies where they have these big plans because they think the market's going to love it, and then they invest all of this capital, and then it's like crickets, right? Or it's not playing out to what. So that's kind of first and foremost. However, you can do that to get a quality product out there, right? Obviously, you don't want like a crappy product, and I'm not advocating drop
Yeah.
shipping. But whatever you can do to like validate the product and then start investing in that. And yeah, cash
Great point.
flow is so big. Well, in every business, right? I mean, that's what takes businesses down is the lack of cash flow and bleeds them dry. And so, yeah, when you're looking at those startup costs, is one is like you invested all of this capital. So I like to look at it in terms of how long will it take me to kind of recoup that investment, right? So what's the ROI on that? And some people it can be longer than others, but you want to have a roadmap of what you're trying to accomplish too. So So some pro forma forecast of expected sales, expected ad spend, expected cost, and really project that out. And I mean, at least have 6 months of cash that you can be like, even what you just talked about, like testing, right? That's going to be part of it.
Right.
You're going to start to notice like what's your return percentages? How much do you have to discount, right? So all these things you're not going to actually know. So the forecast is going to be 99% wrong, but at least it's a roadmap that you can start pivoting from. Yeah, cash flow is big, that you want to make sure, I'd say from the start that you've got like 6 months of runway. Now with D2C brands, that revenue's coming in directly, right? So you're not waiting on invoices, you're not waiting on that.
Right.
So once you start validating that, then you can start, pouring gas on the fire if you've got a great ad that's running.
Yeah.
Yeah.
Sure. Yeah. So I'm hearing from you, first, don't assume that the market's going to love your product. So don't assume that you'll just be able to turn ads on, which I mean, of course, we experienced that Lucid, where a client comes to us, a brand, and they just expect that, hey, once you start, just putting any money in, you're going to get a direct return, and it's just printing money from now on. So not assuming that, and really trying to do it in the least capital intensive way to see if you've got something. And then I'm hearing past that is also don't assume that once you have, even if you have product market fit and you've got a product that the market wants, don't just assume that you can put $1 in and then get 2 out, that there's testing and everything that needs to happen. And so at least a 6-month runway. But actually, what's a very specific question? How do I know what a 6-month runway is? So keep in mind, I don't have fixed costs yet, or I don't have much. And so how do I determine what 6 months runway looks like, or even just estimate?
Yeah. So a lot of the biggest issue that I see there is, right, so you've ordered probably a small stock of inventory, right? Like again, you want to be flexible. So your per unit cost is probably going to be higher than when you get to economies of scale. And I don't know why, because intuitively we know this, but we don't think about it. But you're making these sales and then you're like, okay, we're profitable. And you're like, oh crap, I got to order another lot of inventory.
Right. Yeah.
And coming that for sales. And so that's where you're looking at the cash flow, because a lot of that's not going to be on your P&L, your cost of goods.
Right.
But that's the biggest, like, supply chain can be such a differentiator and competitive advantage if you nail it. So again, that's where I'm saying 6 months, where another lot of inventory, that might eat up quite a bit of the cash that you have set aside.
Right.
And so you just have to be prepared for these things that are coming down the pipeline. Or when you're doing, like, what we're talking about is kind of like risk mitigation, right? And so, like, what if your ad account gets shut down? How else are you getting, clients? And obviously, that happens, right? I'm sure you guys deal with that with certain clients.
Yeah.
And so it's just like looking at all these pieces, but putting them, I'm going to say an Excel spreadsheet, a Google sheet, even on paper. If it doesn't make sense on paper, it's not going to make sense in the real world. So, so you at least have to have something down where you're like, okay, if this all hits, then we're going to be okay. If ad account gets shut down, how are we going to pivot from that, right? And kind of, you can run these what if scenarios. Now, again, it's kind of from a high level viewpoint, because you actually don't know the data till it starts coming in, and then you can make more and more accurate forecasts.
Yeah. Okay. Makes sense. So I'm hearing, even though we don't know that, one, run some numbers, and if it doesn't look good on a spreadsheet, it's not going to look good in real life. So I appreciate that. Run some numbers. I'm also hearing have a chunk set aside. That way, again, if things go well, then I'm going to blow through my initial inventory quickly. So I need to order, much bigger inventory, and have a chunk of capital set aside. That way I'm not continuing to feel just incredibly, strapped every time I'm trying to, grow the business, especially in the beginning where everything's bigger the next time around.
Yeah. Because you want to be making decisions not out of fear or like the business is going to collapse tomorrow. You want to be making decisions that are healthy for the business, and that you're in a point of not having to worry about cash. So, I mean, there's diminishing returns. You can be holding on to too much cash, but when you're a startup, that's typically not the case.
Yeah, makes sense. Okay, cool. All right. So when you talked about profitability and gross margins, is there, I know there's we could talk the whole time about gross margins as it is, but from your vantage point, is there a rule of thumb? Is there a target to focus on, especially when it comes to repeatable goods, like, again, CPG or something like that, repeatable goods? Is there a target gross margin? What do you advise, or what do you see?
Yeah. I mean, so when I kind of draw a line in the sand, I like, and like you said, it's different for every company. But when I draw a line in the sand, I like to just peg that at the start. Like, can we get to 80% gross margin or better? And that's
Ooh,
not the
80.
case for,
Okay.
yeah.
Yeah.
Yeah. Well, so like I'm talking, so again, we're dealing with potential like apparel brands, we're talking supplements. And so again,
Yep.
it's different for business categories, but that's typically where I've seen pegging it. Now, if your gross margin, so when we're talking gross margin, it's really just your cost of goods sold. So your cost of the product related to the revenue, the sales that you generated, right?
Hmm.
So,
Yeah.
so the way that I set that up, then I've got selling expenditures, which we'll probably get into after
Hmm.
this. But it's just that direct, like what's the cost of the goods that I'm selling for these sales, right? And so for different brands, it's like if it's you can only get to 65%, then that just means that we're going to have less below that to work with in terms of expenditure. So we might
Hmm.
you know, we might only be able to spend like 20% on ads instead of like
Right.
pushing that up to 40%, right?
Yeah.
So
Gotcha.
that's kind of where I start playing with those percentages of revenue. But for the benchmark, that's kind of where I start, just based off what I've seen in companies that we've dealt with. But
Hmm.
like in your case, or for like Breeze, it might be less than that, and then we just adjust what the benchmarks are below that.
Got it. And yeah, since we are making it super fundamental, when it comes to gross margin, of course, the actual product itself and the packaging would be included in that. Are we including like the costs of like the mailers and things like that inside of those costs that it would impact gross margin, or how far are we taking the cost for gross margin?
Yeah. So typically, I'm looking at the product cost. So that would be packaging, like the landed cost to you or to your 3PL or to your warehouse.
Yeah.
Uh,
Okay.
so below that, then we've got, the selling expenditures. And within that, I've got the ads and marketing, I've got the shipping and the merchant fees.
Hmm.
So then from
Yeah.
that, I get the contribution profit or the contribution margin. But anything that, because I want to understand, like, okay, if we can get economies of scale and order products, like if you're only ordering, 10,000 and we can order 40,000, now we can see our gross margin go up maybe from, 65 to 69%. And then we can start
Hmm.
projecting on that, as you're looking forward.
Yeah. Gotcha. Okay. So tell me about this. So when it comes to startup, I think we haven't really talked doctrine yet, but I assume that profitability matters to you, and you would value profitability. I'm assuming, but we actually haven't talked about that. So first, profitability, pretty important from your vantage point.
Yeah, from a startup, I mean, profitability is cash flow is more important, but
Yeah.
yeah,
Good.
but
Good point.
as we're looking
Okay.
at profitability, then we roll in other things like when you're ordering inventory to gauge how your cash flow is, you know, what your cash run rate is
Yeah.
on your business. Yeah.
Yeah. Okay. Cool. All right. So when it comes to gross margins, like you mentioned earlier, I'm when I'm getting started, I'm having lower quantity orders, et cetera, probably more expensive than what it will ideally be when it's much higher quantity. Should should I be a brand manager? Should I be okay with less profit margin initially with the hopes that it'll get better as my volume increases? Or is that just like kind of hoping and praying that things will get better in the future and, continuing just to chase profitability? Like what's your take there? How should I look at that?
Yeah, absolutely. So if we're looking at a startup, it to me again it goes back to validation. So I'm not too worried about profitability right at the start in terms of okay,
Hmm.
we like as long as you understand like there's potential different suppliers, we can get economies of scale. We have a relationship with our vendors that like we can negotiate like, if I order, if I've been ordering 1,000, I can order 10,000 and going to get a price break. And then what you can start doing too, but we have to validate and get the numbers back to truly
Hmm.
understand. Because the worst thing you can do is order 10,000 out of the gate and you're selling 100 a month,
Right.
right?
Sure.
And it's eating
Yeah.
up all
Right.
your
Good point.
cash. And
Yeah.
so
So
again, I'm kind of
balancing
going,
like agility with profitability and all of
yep,
that.
yep, yep. So especially at the start, is you just want to start getting some data in, but what can I acquire customers for? Like, what's my CAC? What are my gross margins? Knowing that I can improve those. And there's different ways that you can do that, right? Like once you validate the offer, you can go back to your supplier and say, hey, I want to order 10,000, whatever your deposit is, 30%, 20%, but I'm only going to take 2,000 this month. I'm going to take 2,000 the next month, right? So you can kind
Interesting.
of hedge, your cash with the supplier as well. And again,
Interesting.
having a good relationship with your suppliers is very important.
Yeah, yeah, it makes sense. And so you alluded to you talked about supply chain earlier. What's from your vantage point, like what's really important, especially from a finance standpoint when it comes to supply chain?
Ooh. Um,
Good question.
yeah, well, there's a lot there because it's
Yeah.
not just finance, but it's like it's it's the time, like how long does it take to manufacture? How long ahead do we have to have our orders, right? Really
Hmm.
aligning with taking just enough inventory that you can fulfill orders, right? And so that's a
Hmm.
major one because you never know. I mean, especially right, you get to November and you're forecasting a big spike, and then if it's kind of a dud, you're like, man, I'm
Yeah.
sitting on all this inventory, right? That we got to
Right.
move.
Yeah.
And then potentially what happens is companies might feel forced to discount that, to move it, to convert that inventory to cash. Now you're driving your gross margin down, right? So it
Yeah.
just becomes this ebb and flow. Now you're affecting profitability, but specifically for startups is cash flow. So again, if it's a
Hmm.
startup and I'm like, you know, just you got to convert this inventory to cash, you got to do whatever it
Hmm.
takes.
Yeah.
But yeah, so in terms of finance, it's with inventory. Obviously, it's how can we get the the gross margin. So we're analyzing that. How do we have good relationship with the vendors? How can we shorten the lead time that we need? And so all this isn't like necessarily dealing with finance, but in a certain way it is because it's affecting your financial picture. It's affecting your cash
Yeah.
flow.
Right.
Those are the biggest items. And then you know QC, like quality control, like is it a quality product? Because if you don't, I mean, that's a part of your brand, right? If people
Yeah.
don't like it,
Absolutely.
if it's not quality, then it's a direct reflection of your brand and your company.
Yeah. Yeah. Makes sense.
So
So
sorry, I'm kind
you're
of
talking
getting
about
outside of
cash flow.
finance, but I'm just like
No.
that's what
Yeah.
all comes up.
Yeah. Absolutely. Well, it covers so many areas. And so when it comes to cash flow, and like you shared earlier, like I think cash flow you prioritize over profitability. Yeah. Sometimes I wonder and ask, like, as a growing brand, am I just going to feel broke until I stop growing? Because that's something that's interesting too. Because like I talked about earlier, like we help scale at Lucid, we help scale brands significantly and profitably. Like even on a spreadsheet where we can see how they're very profitable, but yet sometimes they're just stressed, right? Sometimes
Yeah,
it's like, hey, you're showing me I'm making all this money, but it's not there.
yeah,
What gives? And so,
yeah,
talk to me about cash flow. Am I going to feel broke until I stop growing, or what's that look
yeah. So definitely, like as a founder, there's different ways to pay yourself, right? So you look at yourself like if you're working in the business, then you pay yourself directly for that. What would you have to pay
like?
somebody to replace you, right? And then outside
Right.
of that, you own the brand. So you're an investor. And so then you
Mhm.
would be paid difference depending on how you're structured, dividends, distributions, whatever it might be. Now, it a lot of people, yeah, you see these ads. I mean, especially for drop shipping, it drives me crazy where they show their Shopify like report. They're like, I
Yeah.
made two hundred
Right.
thousand dollars last month, and you're like, yeah, you probably took
Right.
home like $10,000, right?
Right. Exactly.
But it is kind of the same because you're always consistently having to reinvest in inventory, right? So you're taking this cash that you've made, you're reinvesting in inventory, and as you're growing, you're having to order more inventory, so it's eating up more cash. Then you start
Mhm.
talking about taxes and all that. But
Right.
eventually you do get to that place of you can start taking distributions and you just want it to be in a healthy way. But, depending on what the vision of that you have for your brand, it can be different for other people. Like some people just want mailbox money. Some people want to scale as quickly as possible and then exit. Then that's when you have a windfall of cash. But it's not like, hey, we had 50,000 in profitability this last month. I'm going to take 40. Like it's not
Right. Yeah.
usually how it
Yeah.
works.
Right. For
Yeah. Yeah. And again, you kind of get that on paper. Like, when are we going to be ordering more inventory? Then you can start gauging, like,
right.
okay, how much can you start taking just so it doesn't hurt the business in any way? And then you can start building on top of that. Yeah.
Yeah. Okay. So, and I assume, and just what I've experienced so far, I assume that as we're growing like this, it seems like when we go like this, things are more expensive and cash flow is tighter. When we're like this or like even this, like it's kind of actually this feels good, man. It feels
Yeah.
profitable and it
Yeah.
feels good. But like when like this, things always feel tighter. And I'm not even money in the founder's pocket, just money and to pay vendors for this,
Yeah.
for that. It just feels tighter. What
Yeah.
can a brand do to help with cash flow even when we're growing like this?
Yeah. So, I mean, well, okay. Before we get into that, is there's
Uh-huh.
a healthy way to grow, right? So companies that are like just scaling like balls to the wall, like sometimes that's not the healthiest way to grow. And a lot of people
Sure.
just, this word scale has kind of taken over. And I think it's kind of losing some of
Yeah.
its luster now. But we want
Sure.
like methodical, healthy growth year over year, right? So,
Mhm.
I mean, I have some brands where it's 100% growth year over year over year. And it's like, yeah, it's stressful. Like things can break. We're
Mhm.
moving fast. We're implementing systems that maybe aren't talking to other systems. So some of the data is like not correlating. So there's all those things that can happen. But if you have slow, methodical, steady growth, you're right. It's less stressful. Profitability is more predictable, right? You don't have like
Mhm.
one down month and you've increased
Right.
your overhead quite a bit and all of a sudden you're not profitable. So yeah, so there's that piece that I would say about like, yeah, just have healthy growth depending on the vision of your
Mhm.
company. Now, there are, if you need a cash infusion, there's different aspects you could do. You could sell a piece of your company. You could, obviously trade that for equity potentially. So you're not really having to pay that back unless you exit or do distributions. And then after
Right.
a few years, you're like, dang, I wish I wouldn't have sold that. But
Yeah.
so
Right.
there's
Exactly. Right.
there's risk to that. You can do the traditional financing, which is like lines of credit. You can, you have the Shopify Capital, which I'm just like, I try and
What
steer
do you think
people.
about those? I mean, this just seems, I don't know, seems helpful, but also just like a really easy way to get yourself like addicted to that short-term money.
Yeah, it exactly. If it's the last resort, so one is it's easy, it's seamless, it can happen within a couple days, right? You get that into
Mhm.
your account. The problem is the time. So they'll tell you it's 10% fee, 12% fee, whatever it is. But the problem is the time that you have access to that capital is very short. They know that you're going to pay that back based on your
Yeah.
sales,
Right.
and usually 2 to 4 month period. They
Mhm.
extrapolate that out. So then if you calculate that over annual, like an APR, it's not 10%, it's like 40%,
Right.
right? So
Yeah.
like,
Right.
so when I tell people like it's much more strenuous to get like a traditional line of credit, but you want to have a source of capital that you can tap into, you can pay back,
Mhm.
you can tap into, you can pay back, and you can just consistently turn it over, especially if you're using that for inventory. Like that's a
Mhm.
good use of a line of credit where you're ordering this inventory, utilize the line of credit, you get the inventory in, you're selling it, you pay back that line, and then you can continue
Mhm.
to flip that and turn it over. And then there's like Wayflyer, there's all these other
Yeah.
other
How does it? Yeah. How does line of credit, even without like some of these, like the ones you just described, but even a traditional line of credit, is there an instance where is there an instance where the music stops and you're stuck with it? So I think in a lot of cases, especially as you're growing, it makes sense to utilize a line of credit because there's this constant bringing money, higher inventory order, bringing money, higher inventory order. But is there a time where like you use that line of credit and then the music stops and you're kind of like, you kind of screwed yourself or at least did a lot of damage? Or is it like, hey, if things slow down, you can just eventually sell off inventory and make sure everything gets paid? Or what are your thoughts there?
yeah, so that's the flexibility with line of credit, right? But like all banks want to see is that you're just utilizing it and turning it over. But like if it has to sit there, there is negotiation tactics, right? Where you could turn that into traditional financing where it's been sitting there for a year, you're making the minimum payment, the interest only, and you're like, hey, I want to take this, whatever amount it might be, and turn it into a 5 year loan. So it's lower. And then when we're looking at cash flow, you're like, okay, my monthly payment is still low. So there is
Mhm.
flexibility there because typically the banks are collateralizing that, but they don't want your inventory. They don't know how to sell it, right? They
Right.
don't want what
Yeah,
you
right.
have unless it's a building or real estate, then they'll take that pretty quick.
Yeah.
Um, but yeah, so you have some flexibility there that you could then convert it. And again, that's kind of where my mind always goes to is like the flexibility piece and the risk mitigation.
Yeah.
Yeah.
Yeah. Makes sense. Okay, cool. Anything else that brand manager should keep in mind when it comes to cash flow? Any like if you remember one thing, remember this when it comes to cash flow, any principles come to mind?
And there's so much around that. So, well, one thing that just came to mind that when we're talking about like Shopify Capital or those types of loans is you do realize when you take that they're going to be taking 15% of your deposits. So again, like when you're making those
Oh,
sales, they're taking it right off the top. So
yeah.
again, when you're looking at cash flow, you have this injection of cash, but you're paying that back. Like you have no say in what they're taking.
And
So
even when it's
again,
higher, so it's not like over a certain amount of time. So like if you do better sales days, if you do better sales days, they just take more and get it paid
yeah,
off faster.
that's right. That's right.
Okay, good point.
Yeah.
Okay.
So again, just be careful of those. Like there's a reason why they're convenient and easy and quick.
Yeah, makes
Shopify
sense.
knows what they're doing. They have access to all your data. Yeah.
Yeah, makes sense. All right. So when it comes to scale, so I'm hearing from you, you know, going breakneck speed and scaling fast, yeah, it can be fun, but it can also be really stressful. And maybe it's probably not for everyone, and probably actually not for most everyone.
Yeah.
Tell me about when it comes to scaling some other things. So should I, or do you have thoughts for as a brand owner, should I be willing to break even on that first order? Or is that just a recipe for disaster? Or what do we have there?
No, oh, I'll kind of answer that with a story. So that
Okay.
first brand that I was working for that we scaled from 4 to 43 million. So there was an aspect of continuity, like a membership plan, like video training, and then we started launching physical products. So with that continuity, we knew the customer lifetime value. So again, when you're looking at major metrics, you need to know that's one of them to a certain extent. That's kind of like revenue. So you need to understand your contribution margin, but I'll talk about that
Hmm.
later. But you need to
Okay.
understand that, and you need to understand your cash flow and how much you can invest into customer acquisition, right? So we understood at that point in time that we could go 4 months before we broke even. And so we were scaling that continuity. And then when we launched physical products, we kind of dialed that back and we started breaking even like in month 2. But we fully understood the customer life cycle. We understood our data analytics. We understood, so we were monitoring that month over month. And then if cash permitted, we could get more aggressive, right? So we could outspend our competition to acquire customers, but
Hmm.
you have to understand, like, if there's any glitch in there, then you might have to pull it back a little bit. But yeah, it's, from your standpoint, do you find that you're able to actually have a profitable acquisition on the front end, or are you typically at least break even, because then it's the customer lifetime value that you make the profit on?
Yeah. So from a vantage point in terms of being able to scale brands, if we can break even on that first order, and frankly, even less, but if we can break even on that first order, then we have a lot of opportunity for scale. When we have to be like, we have restrictions to have to be like super profitable on that first order, our opportunity is much lower. But when we
Yeah,
can break even on that first order, there's much more scale opportunity. And like you say, there's a lot. I mean, there's some great apps like Lifetimely, I think is one of the simplest. You might have one you prefer with Shopify, but there's some great apps just to really get a good idea of what your lifetime value, but what your 2 month, 3 month, 4 month, 5 month value is of a
yeah,
customer. And then,
yeah,
yeah, if we can break even or even lose a little bit on that first order, then we can scale much harder.
yeah. Yeah. And I mean, if you look at, like, some of our clients are like supplement brands, that's a consumable product, which a lot of,
Yeah,
like, your clients are obviously.
yeah,
Like, if it's a good product, does what it says it's going to do, your customer lifetime value could be through the roof. Like, that's where we see.
exactly.
And so, when I'm looking at that, and I look at customer lifetime value, not just that, but the contribution profit from them. So I'm looking at customer lifetime value, removing the cost of goods, the shipping, and the merchant fees, because all three of those are going to be an expense for every order, right?
Hmm.
Like, you have
Yeah,
to
good
ship the
point.
product, you have to process. So then I look at that, and then at what point do we break even from that
Hmm.
cohort on how much, what was our CAC? How much did we invest to acquire that group of customers? And so as we're looking at that, then again, that's when I'm talking about methodical growth, is like, okay, we're just break even. And then we see, like, oh, we're profitable month 2. Like, okay, let's stick there. Now
Hmm.
let's get more aggressive with our spend. Okay, now
Hmm.
we're break even month 2. Cash is good. We're scaling now. Instead of, acquiring, 7,000 new customers a month, now we've kind of pushed that up to 8. Like, then we can start getting
Right.
more aggressive. Instead of just out of the gate, you're like, oh, this works. Let's go 4 months, before
Hmm.
we,
Yeah,
before
yeah,
we break even. And then that can obviously hurt cash
yeah.
flow.
But I think the key thing that you described there is really knowing your numbers and knowing when you're starting to break even and make money. Because what we see all the time is we see brands that just break even with the hopes of one day it's going to get better, and
Yeah,
it never gets better. And so
yeah,
they did all this work and spend all this money to never make any money. And
yeah,
I think that's an easy thing, definitely in D2C, but also in agencies and other where they're not focused on profitability. They don't know their numbers. They think it's all going to get better magically eventually, and it never does. And
yeah, yeah,
it's just
yeah.
a lot of
Well,
hurt. But so key
yeah,
point from
man,
you is knowing your numbers when you will actually make some money.
for sure. I mean, a lot of people, throw around the economies of scale and just think that that's the magic
Yeah,
and what's going to make them profitable. And then when it doesn't, they're like, okay, well, we just need to get bigger. And it's just
yeah,
perpetuating the problem, more stress. Yeah.
yeah, yeah, for sure. And that's actually one of the things I really learned a lot from my business partner Aaron is just prioritizing profitability. And that doesn't mean we can't reinvest, but prioritizing profitability. I've been in companies that are profitable and in companies that are not. And the ones that are profitable are just a lot more fun and less stressful. And a
That's
lot of
true.
times this is a matter of prioritizing it.
Yeah, that's
And
true.
it's,
That is so true.
and I think it's also like standards. Like when you set a standard of profitability, then you find a way to meet it. When it's always like a negotiable, and like you say, eventually when there's economy of scale, we'll make money eventually. And maybe that works in some cases, but in a lot of cases, like especially in the world that we are, just means you had a lot of rough years without a payday.
Yeah. Yeah, for sure. For sure. And
Okay.
again, it kind of
So
goes back to like, yeah, if you're not focused on profitability now, like why would you be at 4X? You know what
yeah,
I mean?
yeah, right.
Like, and
Yeah,
so, yeah, it's kind of got to be a part of the culture. But again, it goes back to every company's different and like, what's the vision of the founder? So, and
right.
then you put
Yeah,
together a plan for that. Yeah.
yeah.
Maybe they
Makes
like
sense.
stress.
Maybe, maybe. Actually, to be honest, I think a lot of people do. And this is a whole other thing. I'm blessed in many ways, and I'm not saying that I have a lot going for me, and I found that I don't. I'm generally like to enjoy life. Like I like to work
Yeah.
hard, but I like to enjoy life. And I feel
Yeah.
like some people like think it has to be hard just always. Like, you can't live a great life. You can't enjoy life until it's a mythical thing that happens in the future. Like there's actually not always, but most of the time you can find ways to, have your cake and eat it too. You can actually enjoy life while building a great business and all that good stuff together.
Yeah. Well, I think a lot, sorry, we're going to get like, no, we're not getting woo woo, but like nobody, sometimes people don't even think about that. Like, what kind of life do I
Yeah.
want to live? Like, how's this business going to
Right.
contribute to it? Because the business isn't your identity, right? You're somebody else
Absolutely.
outside of
Right.
that. Like, it's just a tool to kind of get you where you want to go. But again, a lot of people don't take the time to actually think
You're
about that, what they
absolutely,
actually want.
yeah. 100%. You're absolutely
Yeah.
right. And that whole like mythical, just like you're talking about profitability, like this whole thing in the back of our mind, like eventually things will change. Eventually I'll get what I want. That oftentimes doesn't happen. So whether it's lifestyle design or making money off your first or second order.
That's
So
true.
tell me, the sweet spot again for you was something to 15 million generally, in terms of clients that you're working with.
Yeah, kind of who we serve now. It's like 3 to 15 million is where we
Okay.
see we can kind of help the best. So,
Okay.
I've got accountants and, bookkeepers on my team. So we can kind of come in and be your whole financial arm.
Okay.
We have different service kind of packages that we offer. But really, yeah,
Okay.
it's kind of where we
So
live.
tell me about this. I know there's not an exact standard, but what does OpEx and team size typically look like for like a $15 million D2C? So like obviously we talked about gross margins. We talked about, I mean, 80% is ideal, 65 to 80 is maybe acceptable or so. But like, what type of OpEx do we typically see? What is the team size? What does a good final EBITDA look like? Like, tell me about that. I'm not really aware of.
Yeah, yeah. So again, ev- I always preface with every company is different, but
Yeah, sure.
when we're looking at 15 million, so OpEx or, general and administrative G&A. So that's just kind of
Mhm.
your overhead, your rent, your payroll,
Right.
travel, all of those sort of things. And so within D2C brands, again, kind of like the benchmark that I set with like 80% gross margin, is I like to see that at like 20% or less. So again, how
Okay.
lean can you stay? Now, again, those companies, right, are they utilizing ad agencies? Do they need to bring a CMO
Mhm.
at house? So there's just different questions that you can answer in terms of like what's needed in the business. But the companies, the healthiest companies that I work with stay extremely lean. They have A players on their team, so they don't need, a ton of them. They know exactly what's needed. They have a strong brand, but yeah, they're staying like I have an apparel brand. I mean, she's operating at 15 to 20%, like in that range. And like through
Yeah.
apparel, I mean, the gross margins are great too. She has great repeat customers, but like she's just crushing it. Like profitability, like, yeah, it's high.
You're saying like 15 to 20% net, or you're saying 20% it's her
20% of
costs.
like your revenue. Yeah. So
Yeah.
I'm
Yeah.
kind of
Her
backing
costs.
into, so yeah, if you're at 15 million, like, can you keep your overhead at like that 3 million or under mark for the year? Yeah. And some
Gotcha.
people,
Okay.
again, we're just playing with numbers. Like if we look at percentage of revenue, if you're at 25%, well, that just means that you have less up here in terms that trickles down to the bottom line.
Yeah.
And so that's kind of like, again, just the line in the sand that I draw when I'm first talking to brands of what we want to shoot for. Now, I will say with that, economies of scale can happen, right? So if you can
Mhm.
keep your team size and, your expenditures pretty low, the more you scale your top line revenue, the less percentage it's going to take up revenue. So again, just making sure you understand how that's going to flow when you need to hire people on. And again, the the one thing that I would say regarding your team size is you want to, again, putting it down on paper, because you don't want to hire based on the forecast. You want to hire based on actuals. So, okay, so once we hit this point, we know we're going to need this person. So don't hire him here, because if you don't hit that point and things start going bad, you might have to let them go,
Yeah.
or it's just not a good
Right.
hire. So like when you have these trigger points, that when you hit that, then that means like, okay, we can start looking, we need this person. We feel like they're going to be a great asset to our company. And so that's my piece of advice there. Cause I've seen it
Yeah.
flipped where people are hiring based on the forecast and they don't even get close to that forecast. And now they're bloated within their overhead and
Mhm.
have to make some
Right.
cuts. Yeah.
Yeah. Yeah. That's a good point. Yeah. That's something I learned a while ago. It was tough for me to learn is hire and maintain based off what is rather than what you wish. And
Yeah.
and probably the area that I've lost the most money in the last almost 2 decades is when I've like had people on a team that, hey, this person will be great, or this team will be great 6 months from now when we get here, and just paying their salary and paying their salary and paying their salary off of what I want to be rather than what is.
Yeah.
So that's a tough
Yeah.
lesson to learn.
Yeah, for sure.
What I know it ranges, but what net percentage at the end of the day, the money left over, are you happy with from your vantage point? Or you're like, hey, this I'm happy with from your vantage point for D2C, and I'm sure it ranges so much.
Yeah, it does. But like ideally, like, and I've said this before, people are like, what? Like if you can get to 15 to 20%, people are like, that's crazy. But realistically, what we see is like 5 to 10%.
Yeah.
And so, but when we're looking at that, again, when we're talking cash flow, so again, I don't want to get into all the accounting lingo, but you have things that are not on your expenses on the profit and loss that are contributed, right? Like distributions,
Mm-hmm.
your inventory ordering, like all of that's kind of on your balance sheet. And so you have these other expenditures that aren't shown in that 5 to 10% or 15 to 20% that are going to eat cash. And so that's where, it, what I kind of say is like, if you can get to 10%, just kind of consider that like your new break even in terms of like when you're kind of like
Oh,
monitoring cash
interesting.
flow. So if we
Yeah.
can get above that now again, things like I know we kind of bashed economies of scale, but that's when people don't know. But economies like when you're growing on your top line, that's where you just want to stay really lean on your overhead,
Mm-hmm.
because that's when you're going to increase your bottom line
Okay.
profitability. Yeah.
Interesting.
Yeah.
Makes sense.
But those
So
are
a
kind of
key
the
takeaway
benchmarks
I
that I
had,
look at.
yeah, it makes sense. A key takeaway I had just now is look at 10% as almost your break even. 10% net. I know it's not actually your break even, but mentally look at 10% as your break even.
Yeah.
That's a mental shift for sure.
Yeah. I mean, you're gonna have tax payments, right? If you want to take distributions, you're gonna have like inventory reordering. So yeah, there's
Yeah.
things that hit.
Yeah. Cool. Jarrod, last up, where and how can people find you? And
Yeah.
yeah.
So I, my I don't want to confuse people, but my company is called CFO Expertise. But I did launch a different website to kind of hit on this ideal client that we have in the D2C space called D2C Wealth. So it's DT, like just the letters, no number, D2CWealth.com. So you can find me there. And also, kind of as we've been talking, what I did realize is the relationship between brand owners and ad agencies. Sometimes brand owners don't actually know their numbers, give agencies the wrong number, and then,
Yeah.
they feel like they're performing for them, but they're still losing
Right.
profitability or cash. So on my
Yeah.
website, I believe it's under resources, there's a break-even CAC calculator. So you can
Nice.
go in there, play with it. You can put in your cost of goods percentage, shipping and merchant fees, and it'll kind of break down. If you look at your customer lifetime value, it'll give you a chart of like, okay, if I want to break even month 4, this is how much I can spend to acquire the customers. And so it's been pretty
Awesome.
helpful for people. Yeah, just to kind of give them a
Cool.
benchmark.
Awesome. Cool. Yeah, that sounds like I think I've used that calculator. We'll make sure to include it in the show notes. I was like you said, there's a lot of times where agency is like, hey, we're killing it. client's like, I'm broke, I have no money to pay anybody, and
Yeah.
there's this massive disconnect. But it's because
Yeah.
there's numbers aren't aligned. So yeah,
Yeah.
that's something
Yeah.
really great tool.
And that's where, I understand all of those analytics, which one thing about me is I'm CFO, but I actually don't like accounting. It's too black and white for me. That's why I have accountants and CPAs on my team. But understanding that relationship, and so you need to have those and I don't care if it's with us, but just, any advice is like, get somebody that gets you like accurate financials, because then from there you can actually get accurate numbers to your ad agency. And that's where that relationship is going to be a lot better. And especially for you guys, is like, you think that you're fulfilling for them on what they gave you. And if it's not,
Mhm.
like, it's misaligned in communication. So
Yeah, yeah, exactly. Yeah, and we want to make at Lucid, we want to make, it's like we call them investors. We want to make them money.
yeah,
We don't want to lose them money, even if we think we're making them money. So yeah, that
right.
alignment is essential. So cool.
For sure. For
All
sure.
right, Jarrod, thanks so much for the time. Really appreciate it. I know it's going to be valuable to a lot of people, and I really encourage any brand owners and managers that might have might be able to just get some value from your services to connect with you. I know, like I said, I know one of our clients has gotten an insane amount of value from you, and it's really, you made a huge difference
Yeah.
in the growth of their business. So
Yeah.
cool. Thanks,
And
Jarrod. I appreciate
yeah,
it.
man, this was
Yeah,
great.
go ahead.
But no, I
All
was
right.
just going to say, if people even want to reach out, I mean, like you and I talked about, I'm not a hard salesman. If I can provide any value on a quick call, I'm more than happy to do that.
Yeah, cool. Awesome.
Yeah.
Thanks, Jarrod.
All right.